This is Shahida again, and today we're going to talk all about balance sheets. We are in our favorite website, MarketWatch. We're looking at Nike stock. Under financials, go ahead and choose balance sheet, and you'll see ratios down here. Go ahead and click that. And today I will show you quickly how to look at three things in the balance sheet to figure out if a company is financially healthy. Balance sheets are made of three sections: assets, liabilities, and shareholders' equity. Assets equals liabilities plus shareholders' equity. Under assets, we'll look at cash, which is right here. As you can see, Nike has always maintained healthy cash balances. Except in 2020, its cash positions increased by almost 90%, from 4.66 billion in 2019 to 8.79 billion in 2020. That's curious. But cash alone will not tell you if the company's position is good or not. What you need to do is go to this ratio right here, which you see. It says cash and short-term investments over total assets. It basically says what percent of Nike's total assets is made up of cash. And you can see here, Nike has been consistently maintaining around 24% of its total assets in cash. And in 2020, the ratio went up to 28%. Next, let's look at liabilities. Under liabilities, I like to look at debt. I do not like companies that have too much debt. So go ahead and look at short-term debt here. Nike has $693 million in short-term debt. It's a huge increase from $9 million from the previous year. And go down below and you can see long-term debt. Long-term debt also increased a lot, $12.32 billion. The ratio you want to focus on is this one right here. Right here it says total liabilities to total assets. As you can see, Nike has consistently been increasing this ratio, and it's quite high. In 2020, it has increased to 74.3%. You're curious as to why, right? Of course you are, because you're smarty pants and you want to know why. So here's why. Remember the big cash position Nike had in 2020, which is almost 8.8 billion? Well, guess what? Most of it came through debt. Nike issued new corporate bonds, and bonds are essentially debt. Short-term debt has ballooned to 693 million, and the long-term debt also increased to 12.32 billion, and this is why our liabilities to assets ratio has increased to 75%, nearly 75%. Nike had to borrow because obviously for COVID-19 it needed more cash to manage the impact of COVID-19. Finally, we will talk about retained earnings, which comes under equity, and that's right here, retained earnings. I like to look at retained earnings because it really kind of signals if a company believes it's going to grow or not. So retained earnings basically is the profit, the share of the profit that the company decides to keep for itself, or in other words, reinvest in itself. A company can do two things with its earnings or total profits. It can distribute it to shareholders in the form of dividends, or it can keep it for itself as retained earnings and reinvest. Nike does both. It distributes a portion as dividends, and some portion it generally keeps as retained earnings. However, in 2020, retained earnings is zero. This is very curious. Usually, the signal is that if a company is keeping retained earnings, it is telling shareholders that by reinvesting in the company, the shareholders can get a higher return on their investment through stock price gain rather than dividends alone. The other things companies do with retained earnings is they buy back their own shares or they pay off expensive debt. In this case, since Nike already borrowed and is cash rich right now, that could be the reason they decided not